It is both easier and harder to buy a home. Average long-term mortgage rates saw their biggest one-week jump in 35 years, but the demand for homes is less, which means less competition for you. No matter if you want to do it now or wait, you need to get your finances in order first to buy a home. Nathan Grant from Money Tips is here to help us. He's also answering your money questions, anything money, credit card, credit score related. You can text us those questions. The number is 336-379-5775. Remember, your question is anonymous and it gets answered in real time. All right, Nathan, so we're talking about home buying. Everything's crazy now, but not as crazy maybe as it was before, with people just making cash offers that were like $10,000 and $20,000 more.
Yeah, the main thing to remember is no matter what happens externally, whether the market's crazy, we're in a recession, the Fed rate changes and stuff, there are things that like personal financial responsibilities that you can take to get yourself ready for buying a house. So that's kind of what I want to go over. And I guess we could start with credit scores.
All right, let's do that. Yeah, what do we need to have when it comes to if we want to get ourselves in a position to buy a house?
So if you want to get a conventional home loan, you want to have at least a credit score of 620. That's considered a good credit score. But if you're 740 or above on most credit scoring models, that's going to put you in the excellent range. So you're going to get the best terms and rates for a conventional loan if you're above that number. Now, if you don't have 620, you're not totally out of the loop of getting a house. You just might still qualify for a Federal Housing Administration loan, a FHA loan, or if you're a veteran or in the military, there are VA loans that have some lower requirements too. So you still may be able to get in there depending on where you're at.
Okay, and just a little side jog here. If you're looking to build up your credit score, what are some of the best ways to build up your credit score?
Yep, there's kind of some general things across the board, no matter where you're starting from with your credit scores, that you can steps you can take to personally take responsibility and start turning things around. It always begins with paying your bills on time, because late payments will remain on your credit reports for 7 years at least. So paying those on time in full when possible. If you're carrying debt month to month, that's going to not only cost you more money, but it's going to affect your credit. And if you end up closing accounts once you pay them off, that's going to hurt your credit score. So keep those accounts open if you aren't paying an annual fee to keep them open, and that can help your credit too. And of course, having a low credit utilization, which is the amount of your available credit being used, will definitely help too. So as you're paying down that debt, that percentage is going to go down and help you a lot as well.
Okay, and we can dive into more of those if you have some more questions about any of those kinds of things that he said. But we're going to kind of go down what we are looking at here. So let's talk about that debt to income ratio. That is one of the things you just mentioned. So let's talk about that.
Yeah, so when you go to apply for a loan or for a mortgage, the debt to income ratio basically is all of your monthly debt payments divided by your monthly gross income. So if your monthly gross income is say $4,000 and all your rent and other debts add up to about $1,200, that would be a DTI of 30%. You want to be at or below a 36% to qualify for conventional loan. So even if you're making more per month, and let's say you make like 10 grand per month, if 5,000 of that is going towards your payments and stuff for each month, you actually have a 50% DTI. So that could actually show lenders that you're a higher risk borrower. So really looking at that number, doing that calculation, really can kind of give you a big picture idea of where you're at even before you start the home buying process.
All right, let's talk about down payment. I think that's what keeps a lot of people sometimes from buying a house, is not thinking that they can have enough money to scrape together for that down payment.
Yeah, so you generally want to make a down payment of at least 20% when buying a home, but don't look at that as like a brick wall preventing you from getting a house completely. The thing that will happen if you don't make at least 20% of a down payment towards a home is you're going to have to pay the mortgage insurance. And depending on the type of loan, there's different things. You get private mortgage insurance if you have a conventional loan, and basically you're paying, it's like adding to your monthly payment up until you've paid about like 22% of the principal. So that's one. And if you have a FHA loan that I mentioned earlier, it's a similar thing. It's an MIP, a mortgage insurance premium. That's divided into two payments. You're going to pay an upfront premium at closing, which is about 1.75% of the loan amount. And then you will have a monthly annual premium rolled into your payment as well. So you obviously don't want to pay more than you can or that you have to, but it's good to know that, people are coming from different starting points when they're looking into buying a home. And it's nice to know that it's not just like an absolute hard no in a lot of cases, if depending on where you're coming from. You might be able to work around it. You just want to know these things ahead of time so you're not blindsided.
We have a whole bunch of mortgage questions like this one. Will having a large student loan debt stop us from buying a home?
So, when you're looking at debt, it's good to have a variety of debt because it helps with your variety of credit accounts. But that's kind of like the hardest thing for a lot of people is like, where do I start? And you should generally start when it comes to like paying debt. You want to obviously pay at least the minimum amounts due on everything. But if you're trying to save money and stuff, you towards something like a house purchase or something else just as big as that, paying off the high interest debt like credit card debt, unfortunately, is the good starting point. So, try to like make sure you have a pretty good like emergency savings so you're not dipping into the credit cards to and building up that debt more. But targeting credit card debt, which is usually 20% or more APR on those accounts, you target the high interest debt. That's going to free up more money in your budget to go towards things like your student loans, like saving for a house, etc.
Yeah, and paying regularly on time your student loan could actually help your credit score some because you're showing that you can actually do that. All right, we're going to take a quick break. We're going to be back. We've got 2 more segments with our money expert, so make sure you get your text question. We'll be right back.